Well, we wouldn't be franchisors without franchisees.
Mm,
So
absolutely.
let's speak to that audience a little bit. So if I'm a franchisee or not even an existing, but maybe a prospective franchisee,
Mhm.
but I have the desire to build a multi-unit, perhaps multi-brand. It could be within the same brand. There's big operators, but if I have the desire to build something meaningful, create generational wealth, create a franchisee empire, and they are all over the place. I mean, good operators know how to operate, and within a franchise system, they know how to follow the plan and they know how to expand it. How would you counsel them on how to approach and solve for this outcome? Because there are 4,000 brands to select from within which you can build. They all have different scalability. So how do you evaluate their scalability? There's different, like you said, operating requirements. They're not going to be a good fit for all of them. How do they match themselves up? And then you got to get into the funding thing. Like, what's it going to cost and how do I achieve that? So where would you even start if I came to you and I said, hey, I just sold a company for $50 million and my next go around is I want to build inside of franchising. How would you counsel me?
Um, I would say congratulations, first of all, on building a $50 million company. And then I would say, okay, first of all, what skill sets are you bringing to the table? And I'll say everything that I'm about to say comes from franchisees who have either been very successful or those who have failed. And
Okay.
so I have learned um, them what makes it work, right? So in the case of a franchisee who's coming in, they've run a successful business. The first question is, are they bring any of that infrastructure with them, or are they starting from scratch? So
Okay.
if they're starting from scratch, then they have to realize that they probably already know this. So sorry, I'm talking down to you, $50 million owner, but they have to understand with each business what all of the roles are and what roles they're going to have to be in, right? So build out that chart and what roles are they going to have to be in and understand what are the most important roles during that startup phase. So if it's a service-based business where the roles are heavily on sales and getting new business, like in a service business, either they have to have that skill set or they have to know someone that is going to have that skill set that they can hire because that's going to be the hardest thing getting out of the gate versus in a retail environment, like that's more customer acquisition from a marketing and partnership perspective. And so those who's going to be filling what role, I think that's the most critical thing. I have talked to franchisees who have failed because they hired a salesperson and, they're doing drugs at 9 a.m. in the morning and having to fire them. So
Yeah.
I think it's understand what strengths you have. If you're a finance guy and now you have to go out and sell, like it's not going to happen. So you've got to make sure that in that startup phase, until you get cash flow positive, what are the key critical sets and how are you going to solve for that? So that's number one.
Okay.
Number two would be, and what does the competitive landscape look like? So in your market, right? Are you going against some pretty significant players in the market or is it very fragmented? Every single like successful franchisee that I've talked to before they go in the market, they know. So if they've got to hire, I don't know, minimum wage people that might be evaluating working at, the Wegmans. So like
Yeah.
understanding who their competitors are from a labor perspective and so how they're going to deal with that hiring challenges. And then also competitively for their own product or service, like who are the competitors? Because no matter what, everyone has competitors. That's great. That means that people actually want the service because
Right.
they're businesses. But at the same time, you have to know how you're going to position yourself in the market and talk to the franchisor about that positioning in your particular market. And then the third is making sure that you have enough cash to get through to break even, right? So, and also add some more cash on top of that because life is uncertain.
Right.
I mean, it's more uncertain now than ever before just because there's extraneous things that you and I can't control. We can't control tariffs. We can't control if the government's open. I
Right.
just got driven home by a tax. I live in the DC market. Tax cab driver drove me home. He was waiting for 5 hours for me, his one customer all day.
Oh,
Right.
wow.
So no planes coming in. So my point is he doesn't like nobody. There are things that happen that no one can predict. So you have to have extra cash to make sure you can get through what that period and make sure that even if something happens, you're still fine and you can still continue to grow your business.
Hmm.
Um,
Let's talk about durability just in general. So, number one, it's easier to build a business into a growing market. Back to your point of in an emerging brand that's got a new or unique service, it's going to be a blue ocean. So it's going to be easier to get customers to the extent that customers are educated about it. But then when you say, all right, well, and you talk to the guys that sell or award, we don't sell franchises, we award them, haircutting or food or all of these things, because, hey, everybody has to eat every day. Hey, hair's always going to be growing. But when you get into these types of businesses, you realize very quickly that they're mature markets. They've been optimized for decades by franchise systems, and you're competing for stylists, you're competing for the labor. The margins can be smaller, and you might have to open 3, 4, 5 of these things to make what would be considered a reasonable return for your time, your energy, your money, your opportunity cost. So yes, everybody has to have it every day, but that's why those are so mature and saturated in terms of the marketplace. And then there's other things like certain fitness concepts or that, I like to say, here's my durability thing about Homefront brands, right? There's going to be 150 million more people in this country by 2050. There's already a shortage of the houses. Many of the houses in many growing markets that people want to live in, there is a supply and demand challenge. Less people, yes, less young people are learning to do the trades. So there's a supply and demand curve, which is going to drive the pricing up. And when you have all of this new home building that's going to happen and you've got this population increase, everybody has to have a place to live. That's going to bring new homes. That's going to bring infrastructure, schools, retail, all of this building, and every single Homefront brand participates in that economy. So you will never find a Homefront brand nestled comfortably between a Blockbuster video store and a Curves fitness franchise, because there is no obsolescence in home services. So I make the case that home services is durable. There's a 10.3% compound annual growth rate as far as you can see in these services. So if you can get into this and compete and put your shoulder against the wheel and build a great service business, that it's something that you should be able to not have to worry about obsolescence, meaning people don't like the workout, I don't like the cookie anymore, these types of things. So when people are making, so durability and obsolescence is a legitimate risk if you're looking to invest to build an empire, because 20 years from now, there has to be a customer set and it's got to be a relevant product.
uh, yes, absolutely. And I think that's why there's an arms race to own the home.
Yeah. Yeah. Oh, there is. Okay. Tell me about that.
Well, we've seen an explosion home service brands and the growth of units, and all of them are part of platform franchise companies. And the objective is to have a service that's within all parts of the home so that you understand that consumer from all aspects of their needs within the home. So that's been happening over the last, I don't know, more than a decade,
Right.
this growth. And so, yeah, that's the arms
Yeah.
race to own the home.
How would, okay, speaking to this franchisee, let's pretend that they don't have $50 million. Let's pretend that they're kind of a normal builder, but they still have aspirations to build a large franchisee base of businesses.
Hmm.
What kind of approach to funding something like that? What are some of the mechanisms that good franchisees have access to help them fund and grow a franchisee platform for themselves?
So I'd say it depends on the startup costs. A lot of and how much capital they're bringing to the table. So there's a
Hmm.
couple of variables that might dictate the right answer, and it also
Sure.
depends on the franchise system. So I'll put those two into perspective. So if you have a high performing franchise system with a good kind of credit, that means like the franchisor, even an emerging brand, has shown consistency to keep franchisees in business together between the franchisee and the franchisor, that being a successful outcome, then the franchisee is going to have more options. So
Right.
being able to get an SBA loan, that is government guaranteed. It means a bank that may not otherwise want to lend to a startup business, which banks don't want to lend to startup businesses because they're highly risky, period. Compared to, so the SBA guarantee makes it less risky because the government says, hey, we're going to we have an insurance product that says, like, if it fails, bank will give you 75% of what you lent out. Who doesn't want that kind of assurance?
Right.
75% is pretty great. And then a lot of times banks actually sell off the rest of that to the secondary market. So they've basically offloaded all of the risk. So that can be very attractive for franchisees. Then, of course, there's home equity, lines of credit that some use to finance their business. Some use K financing. So basically, if you have a 401k, you can roll it over to either use as an equity injection to an SBA loan, or use it to fully fund your business and to have some additional cash to help you weather those storms. Or, I would never say fund it with credit cards. So don't do that. And don't get a high interest loan to put you into a problem space to begin with.
Yeah.
And there's always friends and family. So definitely that's always an option, to have people who believe in you say, let me help you. And maybe you give some equity in the beginning to help get that funding. Especially, we see a lot of second generation franchisees, and so maybe that funding is coming from dad, who's a franchisee of another system. Yeah,
Sure.
so those are kind of, I'd say, the key ways that people use to start the business.
Okay. So one of the things that you would ask a franchisee is, who's your daddy?
Absolutely. Or who's your mom?
Okay. Fair enough. Just want to make sure I heard it correctly. All right. All right. Good. Here we go. All right. Sorry. Tickled myself there.
It's perfect.
All right. Now maybe it would be beneficial for this prospective franchisee to think about risks.
Mm.
And so there's been a couple of concepts lately that are loosely in the health and wellness space, but they're more semi-medical, and maybe they do things like help people temporarily with certain types of aches and pains, or maybe they have some therapies, maybe there's hormone therapy, there's these semi-medical things that, as we get into longevity and pain relief, and I got involved in a laser business that was good for circulation. I mean, there's all these great medical treatments are out there. And as they become validated, or at least marginally validated, then, somebody tries to put a franchise system around them. So you get into this franchise system, you build a class B location in sort of a medical facility, and now you're going and you're bringing these customers in, and then boom, here comes a regulation that says that we can't recommend this as a process. So there's real risk. So when you think about emerging, it's like, oh my gosh, this incredible new product that's going to help so many people. But again, outside of your control or even the franchisor's control, there could be regulation that threatens that business. And of course, there's that. And, or, for a franchisor, like I had a restoration remediation business called AdvantaClean. And we were early to the mold remediation craze, right? Everybody, black mold. Here's a story, somebody grew 2 heads in a basement in Cincinnati somewhere from black mold exposure. And now there's all of this regulation that comes out about you've got to do this, which helped us a little bit because that really forced in real estate closings and in water damages. I mean, they created protocols where mold needed to be done. And then all of a sudden it created licensing requirements. in different states. So now we couldn't just open up in different states because somebody had to have experience or industrial hygiene experience or whatever it was. So, and licensing requirements pop up. I mean, there was a new building code that came out in 2025. And one of our there was a very specific code in that building code that deeply impacted nationally one of our brands. So now we had to create new products to get around that building code in places like California and Nevada and things like that. And we couldn't have anticipated it. The franchisee couldn't have anticipated it. It just, but then you have to deal with it. So there's regulation risk that can happen in most businesses. I would think if you're in painting or carpeting or something, I think the risk is low. But if you're in medical or something that's new and hasn't been regulated yet, then there's more risk there. You've already mentioned the staffing risk. Where are you going to be able to find enough of the people at the right price to make the model work? There's a risk from AI. So let's just say you're in a franchise that builds websites. Well, okay. Or even does accounting. So we don't know how AI is going to disrupt those industries, but I can guarantee one thing, it'll be faster in the future than it has in the past. So your time to react. I had an AI expert on the podcast. It was a great podcast. Jeff Woods. I highly recommend it. I don't know, episode 230 something, but 226. And if anybody's looking for it, but the question is the rate of change from AI going to correlate to the rate of recovery from our workforce? Because the rate of change is so fast, but how quicker, we recovered from whaling because whaling died down slowly. And then we got into industrial revolution, and then we were, AOL, dial up. Literally, if you look at the internet revolution or the tech revolution from that perspective, we had dial up, and then we had to build copper wires, and then we had to build infrastructure. Even though it grew extensively over 10 years, up to 2000, from 97, 98 to 2007, when, all the FANGs popped up, Facebook pops up, Twitter, all these pop up. That was 10 years, the rate of change of IA is 10 weeks, where you're getting that level of change. So you need to think deeply about your business and how that's going to, and that, again, right back to home services, which is going to be, it's not undisruptible, but the rate of change, I think can be more predictable inside of that. And then you've got this whole thing of discretionary versus non-discretionary. Is it a have to have or is it a nice to have? If you were in a hanging big screen TV franchise in 2006, 7, and 8, you probably didn't do too well because nobody had to have a 40-inch, 800-pound plasma on their wall. So how do you, I'm supposed to be interviewing you, but those are some of the risks that I think about from a franchisee's perspective. Would you comment on those or tell me what I missed?
Yeah, so I think it's really important to know who your customer demographic is when you are buying any franchise business. I look to McKinsey does a consumer insights study. It's public. You can look online. The point about discretionary versus indiscretionary is really important. And I would further dig down into that because part of it is where are people going to spend their money, right? So sure, your air conditioning blows out in 4th of July, which happened to me. And did I immediately call a franchise and the franchisee came and fixed it the next day? Absolutely. Like is not a choice in July, 90-degree weather in Washington, D.C. Okay. So, but then there are choices that people make even when it's some would say like discretionary versus non-discretionary, where people only have so much money and where are they going to prioritize their problems?
Right.
And where are they going to prioritize their choices for their, how I'm going to treat myself. And I think it's super important. The reason why I talk about McKinsey is because they talk about by age category where people are going to spend money. So where they're going to splurge, right? So am I going to splurge on cookies? Me, no. My age category won't, but the younger age demographic will. So, so I think it's important to know your customer and then know how customers make decisions about what's important to them and that wallet share, right? So if you're going after consumers that have in this environment are higher end consumers, they have a bigger wallet share. They can spend more money. They can execute on more of their priorities. So I think those are kind of how I think about it. It's useful for a franchisee to take all those things into consideration.
Right. If consumer debt goes up and the economy slows down, are people going to push out their hair color another few months? Or are they going to quit their Pilates studio? It's which one of those is going to be. I mean, at the end of the day, now if
And
you're in hair cutting, people need to get their hair cut, but the Flowbee does exist. You
so
can,
funny enough, it really depends. So I'm in the category where apparently I don't care about my wellness as an older woman. So
okay,
I would give up my Pilates apparently, but if I was younger, I would not be giving up my Pilates because we care more about the way we look when we're younger.
right. Yeah. So I mean, but at the end of the day, in the order of magnitude in the food chain, are people going to eat out less? And what is that going to be? So I think it's a huge data crunch to know what people are likely to do and then
Hmm.
how that impacts. I know that during COVID, the moving and storage industry didn't do particularly well, or either was coming out of COVID. But fitness, COVID changed the numbers in fitness. I mean, it changed the way that people get their fitness. And it's just there's some predictability, but at the end of the day, if you're going to be investing your life and your life savings in something, then it and you want to really commit to build something over 10 or 20 years, then these are some of the things that, to the greatest extent possible, you need to minimize your downside.
Absolutely. And I'd add to that um, within any industry,
Mm-hmm.
there's always winners, right? So
Yeah,
if you
true.
look at the sit down restaurant space has been declining year over year, but in the last couple quarters in the last year, Chili's has been knocking it out. So there's
Yeah,
piece to this that is execution. So you can always win over consumers. Same thing in fitness. Planet Fitness didn't skip a beat, really didn't miss any customers throughout
right.
COVID. So even though the vast majority of fitness brands really took a beating and the vast majority of sit down restaurant, there's a piece that's also like know your consumer, know what they're able to spend, and then speak to them where they're at. And that is across any industry, right? So just layer that on top.
Awesome. Okay.